Hello, everybody. I think about 150 people registered for today's initial fireside chat of the deferred compensation plan. Waiting on a few more people to come in. Hope you're having a good lunch. So this is the first, we're trying something new to demonstrate and to educate people about the deferred compensation plan. I'm Hank Levy, treasurer, tax collector, and they call me plan sponsor or plan officer of the compensation plan. Today's webinar, it's live. It'll be recorded. We encourage you to ask questions during the webinar, and I will give you some instructions in a second about how that's going to work. First, I want to introduce who I'm with. I'm with 3 of our 4 financial counselors, our financial educators, whom hopefully many of you know, many have you met with, and we want to encourage you to meet with them. We'll give you their contact information when we're done, but I'll let them introduce themselves. Dan, Jean, and Darrell. Dan, why don't you go first?
Yeah, absolutely. So my name is Dan Robinson. I'm a retirement plan advisor with Empower. Empower, if you don't know, we are the retirement plan administrators for the 457, but also on top of administrating the plan, we want to make sure that we provide that retirement support. So that is my role is stepping in as one of those retirement plan advisors alongside Jean and Darrell here. So I've been in the industry for about 7 years now. And yeah, I'm passionate about, helping to make sure that we get there on time and that we are ready for retirement. There's a famous saying that you don't know what you don't know. And I run into that a lot with participants. So there's never any dumb questions. And, that's what we really encourage you to give us those questions today. So.
Perfect.
Gene.
I'm Gene Hilliard. I'm Vice President Financial Advisor of Emerge Financial Group. We're a financial services company here in Oakland. We help our clients with financial planning. We do taxes. We do accounting. A little bit about my background. Been in the business roughly 23 years, helping my clients create wealth, maintain that wealth throughout their lifetime of their kids and grandkids. I'm also a retirement counselor. Since working with Alameda County roughly 17 years ago, I was hired by, at the time, Prudential, now Empower, and the county to provide retirement planning, investment advice, and education. Really, my role and my goal as a retirement counselor is to make sure that each one of you maintain your current lifestyle in retirement. What exactly does that mean? That means the exact same paycheck you're getting today, I want to make sure you get that paycheck in retirement. Okay, you're halfway there because you work for Alameda County through ACERA. You stay with the county any significant amount of time, you're looking at possibly half your salary. Okay, so it's a pleasure and it's an honor to be here today. And Hank, I appreciate you inviting me, and I look forward to this fireside chat.
Good afternoon. I'm Darrell Pitts, and I am a first vice president with Wells Fargo. I came into the deferred comp business with Mark Tomei, who was one of the, leaders in bringing this plan to Prudential and subsequently to Empower. And so Mark, as you may know, has retired. I'm stepping into his shoes to kind of pick up the slack a little bit there. But I've been in the business 30 years, and so I have a lot of knowledge about investments. And I'm a local kid, born and raised in Oakland, went to Cal, and married with 3 kids. So I know a lot about retirement and how to help people out with their finances. So thank you for having me.
Thanks, guys. And Dan, we have a 4th counselor who's not with us today, right?
Yes, thank you. So on the Empower side, you might also see a gentleman by the name of Jose Anaya. He is also a retirement plan advisor, but he is primarily there to catch overflow and make sure that, we still have a counselor that can meet with you if for some reason I am unavailable, or if my my meetings are full, we still want to provide that extra support. So you may also see Jose when you sign up for a retirement planning session.
So the purpose of today is to introduce you to the 3 out of our 4 counselors so you can more likely carry on the conversation and ask your questions by making an appointment. It's totally free. It's not free because you are paying for the plan, but it's part of what you pay. There's no additional cost. So really make use of these resources. Now, we do know something about you, even though we can't see you. We do know something about you. About a third of you no longer work for the county, which makes me think you're mostly retirees, which is great, which pretty much mirrors the composition of the plan anyway. About a third of the plan are retirees. So that's great. So we're going to talk about questions that concern retirees today. The questions, when you registered, about a third of you actually asked questions. You pre-populated the questions. And I want to tell you, and I want to tell the panelists here how it ranked. So a lot of the questions so we had about 40 questions. About 9 were on RMDs and withdrawals. About 6 were on contributions. 5 was on taxes and strategy. Pretty sophisticated ones too, I might add. About 5 were on portfolios and investments. Also pretty sophisticated questions. 4 were on transfers and rollovers. 3 were on plan comparisons. How does DC plan compare to other ones? 3 miscellaneous in general. 2 on loans and hardships. Roth had 2. Beneficiaries had 2. Okay. So that's kind of how it breaks down. We have an hour with you. We'd like to take it in order. And if you want to add to questions or if there's anything that we haven't addressed, type it in to the Teams chat. So here's the order we'd like to take this in. The basics, and I think most of you are pretty sophisticated, probably don't need too much time with the basics. 2, enrollment and getting started. 3, participation, who can be in the plan and how to actually, how to enroll. That's the first one. Contributions, distributions and RMDs, required minimum distributions. Investments, beneficiaries and estate planning, hardship withdrawals and loans, and then miscellaneous and wrap up. Okay, so we have about an hour. So let's start from the top. Basics. Dan, anything? Keep it short. Anything about basics you want to?
Yeah. I think that starting at the very basics, because a lot of people I've run into, they don't know what the 457 is. So just to give you a brief explanation of that, as we already mentioned, you are paying into your ACERA pension, and that is separate from the 457. That is based off of years of service in a tier and formula calculation that they base it off of your salary. And that is guaranteed money for the rest of your life. But that is usually not enough. California is very expensive. So the 457, it's a voluntary account, which allows you to contribute additional money from your paycheck. A lot of people describe it as like the government version of a 401k, if you've ever heard of those. And you control the contribution. You can do a flat dollar amount or a percentage. You can change it at any point. There's no open enrollment period. There's no time frame for that you have to do it. But that money does get invested. And it has the ability to grow from now until retirement. And you also get to choose how it's invested. There's a few different ways to do it, which we'll talk about today. And those are not set in stone as well. You can change your investments at any point. But that essentially will act as an additional income in retirement once you separate from the county. So that's the easiest way to explain it, I think.
Any you want to add anything, Gina?
Other than, I don't know, Dan, if you mentioned that, everyone's available to participate in the plan, whether you're tapped, service is needed, permanent, full-time, you can participate in the plan.
And that's new, Gene, right?
That is new.
Part-time, taps, that's new.
Mm-hmm. With your leadership, we appreciate that. Because I've had TAP employees say, Gene, I really appreciate the fact that the county's given us that opportunity.
Great.
Yeah.
I'm glad to hear that. Okay, that's the basics. Okay, how about enrollment? Getting started, how to enroll,
Okay.
Get started.
How do you get started? Well, it starts with an enrollment form. There's going to be some nuances to how to sign up going forward. But for now, enrollment form, you're going to complete your information. You're going to tell us whether or not you want to invest pre-tax or after-tax, Roth. You're going to give us a percent of your salary or tell us a dollar amount to participate that you want to contribute to the plan. Choose your investments, sign off, choose your beneficiary, send the information in, and within 2 pay periods, money's going to be taken out of your check and deposited into your account.
And online enrollment now it's all online.
It's online.
That's
What's not online is if someone wants to change, their right. Okay.
Correct. I will say that when it comes to the online enrollment, there is an enrollment flyer there's an enrollment code that changes once per quarter. The current one is set to expire, I believe, October 1st. So you do want to obtain that flyer and sign up before that deadline, because you can still sign up after, but there'll be a new enrollment code at that point. So you would have to reach out and get the new enrollment code at that point. And then, it's all done online at that point. In order to change your contribution, you can do it still through the Alameda County Deferred Comp website, and even through Plan Resources. There's a link to a little web form that you can change your contribution directly through the county, but it's not done through the Empower website itself.
I know we should. There's something I'd like to emphasize, and I'm going to ask you, Dan, which maybe we'll repeat at the end. How do people reach us? There's one phone number, which maybe we can put on the screen, or we'll say maybe you can say what it is. And then then they can reach and tell us how the phone number works.
Yeah. So it is listed on the Alameda County Deferred Comp website. You'll see all of our portraits on there and the phone number, but it's 855-WOW-457B. You know the number by heart without the letters. What's the number without it?
So it's 855-969-4572.
There it is. And I am option 4. Either myself or Jose is option 4 to sign up for an appointment with us. Mm-hmm. And for you guys?
Well, number 1 is for if you want to reach someone at Empower. 2 is if you want to reach someone at the treasurer's office. And option 3 is if you want to meet with Darrell or myself to schedule a one-on-one appointment.
Yeah.
Okay. Great. So that's how you get started. Okay. Participation, we've talked about. Everybody is eligible. Contributions. Okay. So a lot of questions came about contributions. How much? Well, you've already addressed it a little bit. How much? Retirement readiness. Some people ask, can I contribute after I leave Alameda County as a retiree? I think catch up is a big topic that people don't understand, and then maybe a little bit about regular versus Roth and how that works. Yeah, you want to?
Well, the minimum is $20 per pay period. Okay, and the maximum that you can do is $24,500. And then you have a catch-up for individuals between the age of 50 to 59, and that number is $32,500 maximum contribution. And then there's a super catch-up where it can be $47,000, $49,000 in that number. And so there's ways that you can, if you get started late in the plan, there's ways for you to catch up. And so, but it's easy when you sign up to figure out what amount you're going to put into the plan. And I think that gives you a general idea.
Yeah.
If you can afford the maximum, 24/5, you could take, we have 26 pay periods, and you could simply take 24/5 and divide it by 26 and get that, and that could be your number.
Right.
My recollection of what the average contribution is, most people do it by percentage. Well, actually, I'm not sure, but when it comes to it, most people contribute between 6 and 10%. That's sort of like where the average is.
What I would kind of add to that, and I always tell people, is start with what feels comfortable. you don't have to hit it hard right off the bat. Start with a number that feels comfortable and feel how that is in your paycheck, because you can always increase it over time. And that's what we recommend, is increase it over time, because you don't feel the financial impact as much if you do it over time. You get used to it coming out of the paycheck. And I definitely recommend doing it as a percentage, because if you get a pay raise, it automatically will increase your contribution based off of that percentage as well, instead of doing a flat dollar amount where you'd have to go in there and update it yourself. And we work Monday through Friday. We forget about this. So it's better to set it to something that's going to do it automatically for you. You'll thank yourself in the future. Yeah. And one thing to add too, I would say, I get that question a lot of like, what is the right amount I should be contributing? And I will say it is different for everybody. The first thing that you need to focus on is making sure you have emergency funds. We always tell people you want to make sure you have an emergency fund established, and then high interest debt. If you have credit card debt or high interest loans, usually that's a really good place to be paying down too. But besides that, on top of that, if you have additional discretionary income past that, definitely consider putting it towards your retirement, because that's something you'd be seeing back in the future. So you're paying yourself.
If I could just add to that too, before I became the treasurer of the county, I was a CPA, and people would often ask me this question: how much should I contribute to retirement? I always felt that there's a lot of financial needs that every person has, every family has. And I always felt, this is my own personal advice I'd give to people, you feel better when you're doing a little bit to everything. I mean, there are some things that are better to do, like pay off credit card debt and things like that. There's some really clear things. But in terms of saving for your children's education, college education, or saving for a home, or doing retirement, I always felt that it was better to do a little bit in each pot. Yeah. Instead of like focusing. So like I said, sometimes it's clear, but sometimes it's just not so clear.
Yeah.
So we're getting some questions online about post-retirement. Can I contribute post-retirement? Can I contribute post-retirement?
No, is the answer. You may have another retirement plan that you might be able to roll over to the county. The county would have to make a decision on that. But money has to go into the deferred comp plan from payroll contributions. So unless you're employed, that's the only way to do it.
Yeah.
Right. Okay.
But I will add that after you separate, the money in your account still stays invested.
Right.
No new contributions going in, but the existing balance still stays invested and continues to grow after separation.
Okay. So that's, and like Darrell was saying, we are allowing retirees to roll in their other pre-tax accounts. So that is allowed. Post-tax accounts are not allowed into the plan. But pre-tax accounts are in general, right? Okay. There's a question that's come up about costs and investments, but I think I want to put that off about cost of investments. I want to put that one off a minute. Let's talk about distributions now. What are the ways? So this is obviously for the retirees out there. What are the various ways that people can take their money? Explain about RMDs as a specific kind of distribution. And then if we hopefully, because I've been dealing with one particular retiree about withholding. I don't know if that's a common question, but I know something about that.
Okay.
So, but why don't you start?
All right. Well, let's talk about what are your distribution options once you leave county service or retire. Okay. Number one, you can leave the money in the plan and let it continue to grow over time, and then just ask for money on an as needed basis. A lot of participants, they have their bills. Then you have your ACERA. Then you have your Social Security. Maybe you're short a couple $100s a month. You can take a systematic distribution from your plan. Okay, that's an option. You can take it quarterly. You can take it annually. It's completely up to you. Or you can ask for money as you need it. Many of you, I have found, at least in my experience, Social Security and ACERA covers pretty much your necessary needs. And maybe you want to take a nice vacation, so you can just ask for money as you need it. Okay. Now, when it comes to RMD,
Let's stop you just for a minute, too. Because when you ask for money, it's taxable.
Correct.
And so what do you do about the withholding aspect? How do you communicate to Empower to withhold some money?
Well, I'll tell you this. Empower, and Dan, you correct me if I'm wrong.
Sure.
But from what I understand, Empower will withhold 20% federal and roughly 3% state if you're in California. If you want something in excess of that, on the form, there's a place you can check to say, I want some additional money taken out of my out of this distribution to go towards taxes.
It's just like withholding.
Correct.
Right.
Correct.
And I will add to that too that those withdrawals or that 20% withholding is set by the IRS. They require that 20% is withheld to cover taxes. And at the end of the year, when you get your tax forms, you will use those numbers and the withholded amount to file your taxes. And if your effective tax rate is less than 20%, you will actually receive a refund for the amount that you are owed. And if your tax rate ends up being higher than 20% and you didn't withhold more than that, you might still owe taxes too. So just keep in mind 20% is the default, but it comes down to your own individual tax rate when you file taxes. And then I will also say as well is that, and we might dive a little bit deeper when we talk about RMDs, is that you pay taxes only on pre-tax dollars. Roth dollars that you withdraw are tax-free because you actually pay the taxes up front when it's Roth. I guess let me throw this out there because this is a very common thing we run into, and I want to make sure that people have a general quick understanding of Roth versus pre-tax. So there's two different types of contributions in this account, Roth and pre-tax, and you choose how you want to do your contribution. And it basically has to do with when are you going to pay the taxes? Because pre-tax, that means that you don't pay any taxes right now. That money comes out of your paycheck, it goes into the account, and it grows. And later on in life, when you take the money out, then you pay the taxes. And the tax rate that you will pay will actually be based off of what your income level is in retirement. So as we talked about, you'll have your ACERA pension, maybe Social Security, your investments, and all of that together determines your total taxable income and what tax bracket you fall into. Roth is the opposite. Roth means that you actually would rather pay the taxes now based off of what your current tax bracket is. And then that money goes in, it grows, and later on in life, it's tax-free because you paid it all up front. And that's usually more beneficial, typically for people who they don't think they're in their highest earning years yet. You know, a lot of the times younger people, we expect to get maybe promotions, cost of living increases. If you think you're going to be in a higher tax bracket later on than you are right now, Roth might be a good option. So that's a general understanding of that.
I would say the other aspect is if it's preventing you, it's not just a tax question, I would argue.
Yeah.
If it's preventing you from putting in more because you have to pay the tax because you're doing a Roth, then I would say then that leans towards doing a pre-tax.
I would definitely say it's always advisable to talk to a tax professional, talk to a tax advisor with this because everybody's individual tax picture is different. And it is correct that when you do Roth, it is counted as income this year. So if you're on the verge of going into the next tax bracket and you're doing Roth, it's considered income and it might push you up and it might not be as advantageous. So it's worth it to talk to a tax advisor.
Yeah. Let me read some questions that we got on RMDs.
Yeah.
I'm just going to read them and then maybe Gene, let me just read them because there's some are similar. I'm interested in finding out when I'm required to start taking money out of my account. Is there a best time of year to take your RMD? When do I start withdrawing the minimum distribution amount, and how is that determined? Is it the same amount each year? How does one calculate a minimum required distribution? Do I have to begin minimum withdrawals at age 73? When should I start taking dividends from my account? How are RMDs handled once participant reaches age 73? So, take any of those or all of them.
Yeah.
All of them if you want.
I'm like, oh, Hank, you're killing me. How am I supposed to remember all that? I'll do my very best. Let's start with RMD. When are you required to start taking out your RMD? 73. Because of the Secure Act 2.0, it was changed from 70.5 to 73. All right. When should you take it? It's advisable you take it at the year end in the year you turn 73. But you do have the option of waiting until April 1st of the following year to take out your RMD, that first one. The drawback of doing that is you're going to have to take out 2 in 1 year. Right. So the tax consequences could be pretty severe.
Right. How are they calculated?
How are they calculated? It's based upon the IRS tables. So hypothetically, say you're 73, typically the IRS tables are going to tell you that you should disperse this money. I believe it's in 25.6 years, right? So they take your year-end balance of the previous year, multiply that times 26 or 25.6 years. I forget how it goes. And then they do that every year. Then it's 24.6 the following year,
so
based upon your balance.
They take the balance and they divide it by the number from that table, which is your life expectancy. So it'll change every year.
Correct.
We don't know how much because the numerator will change and the denominator, of course, will change. We know what the denominator will be, but we don't know what the numerator is. Okay.
And it's based upon, like I said, the year-end balance of the previous year.
Right.
That's how they determine what your RMD is going to be. When is a good time to take it? I mean, depends on you. It depends on your cash flow needs.
And you can take it every month if you want to, as long as you take the minimum.
Correct.
Okay? And you can take more.
Correct.
You can take more than the minimum.
Correct.
But that's a minimum.
Now, keep in mind, there is a severe penalty if you don't take out this money by age 73. Now, also keep in mind, if you're still working for the county and you're 73, you're not required to take out that RMD, at least out of your deferred comp account. But if you have other outside 401ks, et cetera, RMD may still be required to be taken out, but not with the county.
And let me ask you, Dan, Empower will do this automatically.
We help calculate it. Yeah, we
calculate it, and you'll sort of force it on people.
Well, they
Empower will force it on people.
I believe they will notify people of the RMD, but it is still it is required that they make that withdrawal. Yes. I think they will do it as an automatic, but it's still like the IRS. Don't rely on the automatic is what we always say, because the IRS will say in the end, it is your responsibility to make sure it happens. So just make sure it happens. That's all I tell people.
It's like property taxes.
Yeah. Don't trust technology with everything.
Don't wait to get the bill.
Yeah.
It's your responsibility to pay it.
Yeah.
Okay.
Now, I will add as well is that the U.S. government is increasing that age in 2033. So I believe it's going to be going up to 75 at that point. So if you're retiring, if you're not going to hit 73 by 2033, then you're aiming towards 75 as your RMD. Yeah.
Right.
And one last thing to add too is it only applies to pre-tax balances. So if you have Roth balances where you've already paid the taxes, that's not subject to an RMD. You can leave that growing untouched. It's just the U.S. government wants their taxes. So if they haven't gotten them yet, that's going to be part of RMD.
Okay. Do you have anything to add from your background or?
What I like to tell people, when you do the RMD, you need to probably incorporate your CPA, an estate planning attorney, and the financial advisor, so you can sit down as a team and figure out where your tax situation will be and how you can spread this out over time, where it's more advantageous for you as a person taking money out, because you do not want to push yourself into a higher tax bracket. So I think that's a way to handle it.
Okay. Before we leave the subject of distributions, let's just talk about leaving money in the plan or taking money out. What are the pros when someone retires? What are the pros and cons of taking money out of the plan or leaving it in?
Okay, I'll take that. People come to me all the time and talk about, all right, I'm retired. What are my options? What are my distribution options? And I went through, you can take out money monthly if you need it, or just ask for money when you need it. But let's say hypothetically, you're a person who wants to invest in individual securities. You want to buy Apple, Amazon, Nvidia. I'm not suggesting that folks go buy them, but you want to buy individual securities. That's not available in the plan. So it may make sense to roll your money to a traditional IRA. There's no harm, no foul with doing that. Okay.
Now, I do want to say that there is a solution for that if people want it, and they should let us know. There's something called a direct brokerage account, which we could add to the plan. We really haven't gotten a lot of people asking for that. But that is one way of doing it. You know, the other thing too I have to say about having access to some of those stocks, you do get it through the funds. You do. Especially the funds have a lot of those stocks in them. But if you want to load up your portfolio with only 1 or 2 or 3 companies, yes. And we don't advise that.
No, we don't advise that at all. But if you're looking to roll your money to an IRA and you're going to invest in mutual funds, similar to what is offered in the plan, I'm not sure it truly is in your best interest to move that money over.
Yeah.
Stay with the plan. You're part of a $1.5 billion plan. And because of the size, I don't know for sure what the number is, but it's in the billions. And you're part of a plan that, because of the size, you get the great mutual funds. You get institutional shares where the internal costs are a lot lower, right? So you're pooling all of your assets together as a company, as an organization, to get the best deal possible out there. And if you roll your money over to a plan on the outside, you're going to be treated like a $100,000 client. And the fees, structure, et cetera, may not be in your best interest.
One thing.
Yeah, I want to talk about fees.
Okay. One thing else too is if you roll that money before you're 59, you're going to subject yourself to a 10% penalty if you roll it to an IRA. But if you leave it at the county, you don't pay that 10% penalty.
Good point.
I want to talk about fees. Fees are pretty mysterious, and we're getting some questions about fees. They're so important that actually I did a 4-part video, which can be accessed through the website, right? So sorry about that. It's about each is about 4 or 5 minutes long, but it took a long time to explain it. And I'd like to just take a minute if I could, because it's a hot topic. There's 2 sets of fees that everyone should know about. And if anybody's thinking about rolling out to a retail advisor, these are questions you should ask. There's 2 levels of fees. One is the fee that goes to Empower, goes to the financial counselors, goes to our legal costs, our consultant. And that's a fee that's about where now, and you pay for that. You see that on your statements. That's about 1/3 of what you'd pay, maybe even 1/5 of what you'd pay outside to an outside advisor. But there's another set of fees that are much more hidden, which is the management fees within the funds. So as Gene was saying, if you bought XYZ mutual fund outside, you'd be buying a retail version of that. With us, you could be buying the same mutual fund, but it's the institutional, it's the institutional one that also can reduce your fees by 50%.
Yeah.
So there's 2 levels of fees. Please watch the videos I did to help explain it, and where you can get information on the specific funds within our plan. And if you ever, again, I'm repeating myself, if you ever think about rolling out your money, make sure to ask those questions of the outside advisor before you take that leap.
Yeah, Alameda County is a very big plan, so it has a lot of pull when it comes to negotiating fees. I will also say too that a lot of people like the ability to invest and choose their own individual stocks and everything in an IRA, but the one beauty of Alameda County is because it is Alameda County, there is a committee that meets and does their due diligence to protect participants. So they look at the funds that are available to choose from, and they look at the management team of those funds. They look at the performance of those funds against their peers within the same categories. And they look at the expense ratios, those fees, to make sure that they are, on a lower end. And if a fund is not performing, then it gets put on watch. And then if it continues to not perform or meet those standards, it can be changed out for a better option. So there's a lot of due diligence to protect participants within the fund that you really might not have in an IRA where you're kind of trying to do everything on your own. So that is another potential benefit as well.
One other benefit of staying in the plan is that we're committed to looking at a diversity of investments, which now, I don't know, but those of you may know that there's something called alternative investments, which consist of real estate, private equity, private credit, infrastructure. And I think private advisors now are able to sell these on a retail basis, but they're a lot more expensive, and we're going to try to provide these things for you within the plan. They're not available yet. They probably will never be a core fund, but it will be part of other things that maybe we'll talk about this on investments. What are the choices? I'm seeing a question on the screen about contributions, and let me just read it to you. And Darrell, maybe if you want to try this first. What process members must complete to have their catch-up contribution amounts rolled over into a Roth IRA? And I think whether that rollover can be set up automatically in advance before the contribution cap is reached, rather than requiring manual action later. Can you answer that?
I think Dan wanted to answer that question.
Yeah. So this may be in reference to a new rule this year. It might not be, but essentially there was a new rule added in 2026 that says if you are a FICA wage earner, meaning that you pay into Social Security, if you make more than, I believe, $150,000 or $150,000 in income, then if any catch-up contributions that you do above the normal $24,500, if you take advantage of any age-based catch-ups, then it has to be contributed as Roth. The good news there is that the 457 is actually capable of housing both balances, Roth and pre-tax. So you don't actually have to open up any new accounts or any new Roth IRAs. It's all still under the 457. And I believe that payroll is pretty good at knowing when you're hitting that maximum pre-tax contribution. And it, I believe, will automatically start going into Roth. You actually don't need to specify that it needs to start going as Roth. They will do it as Roth at that point. Yeah. But I throw this out there again. The IRS will tell you it's your responsibility to make sure it goes to Roth. So double check as you're approaching that limit that it is contributing as Roth, because you need to make sure it is contributing as Roth at that point. Yeah.
I think it sounded like this person may be referring to the Roth conversion, in-plan Roth conversion. And if that's the case, just to kind of give you background, for I'd say 100 years, 50 years, maybe longer, you were only able to participate in the pre-tax version of deferred comp. That's it. And within the last roughly 10 years, 11 years, somewhere in there, you've been given the opportunity to invest in the Roth version. And so there are quite a few folks that believe, you know what, I want to diversify my tax strategy. You know, I want to balance it out. I want to have pretty much an equal amount in pre-tax, equal amount in Roth. Wouldn't it be nice if I was able to convert some of my pre-tax money into the Roth? And with your leadership and the new rules changes, you now have that opportunity to pull some money out of the pre-tax version and deposit that money into the Roth. Right. Now, there's a lot of caveats associated with that. There's a form you'll need to complete. You tell us how much you want to convert, and you're off and running. The drawback is that you need to pay the taxes on that conversion, and the money must come from an outside account. So that potentially could be problematic. And then not only that, you're adding to your income for the year. Mm-hmm. So you gotta be careful. Right. And as we always say, check with your tax person, check with your CPA to confirm whether or not an in-plan Roth conversion makes the most sense for you and your family.
We just got another question. The Roth only became available towards the end of my retirement. Can I convert it to Roth?
That's it. After
paying the taxes.
And I will say too, is it can actually be done in retirement. So, you know, what often happens for some people is that their income bracket their tax bracket might drop when they retire. And the conversion, the amount of taxes you pay when you convert is based off of your current tax bracket. So if it's lower in retirement, some people will do that conversion even after retirement. So they're paying taxes on that converted amount at a lower tax bracket. But again, that's why it's worth talking to your tax advisor, because they can come up with a strategy to split it up over multiple years and save you the most on taxes.
And I hate to give you guys a surprise, and I want to tell the audience and you at the same time, if anybody's in this situation where they're doing a catch-up or paying more than the 24.5, come talk to one of the advisors, because we actually are in the middle of weighing some other options.
Oh, okay.
Yeah. So just want to let you know. Make sure to talk to us. Okay. Well, this is going great. We have about 20 minutes, and we're working through this really well. let's move on to investments. Let's talk about what people have, the choices people have. Let's make sure we mention GoalMaker and managed accounts. One of my favorite questions, which was somebody asked, please tell me about the Fisher Price thing you have. So I love that. Right. We don't have Fisher Price. Fisher, not Fisher Price. But and fees we already talked about a little bit. Switching between accounts. There's a question that did come up about investment advice. Is there a fee? And if so, how are they structured? So maybe we could talk about that in terms of, the fees for advice. You wanna start?
No, there are no fees other than what you're paying for the county fees. And, we're giving this service as part of the county plan. I think when people look at the investments as a rule, they should look at what their investment objectives are first, and then make a decision on which of the investments in the products that we have fit their goals. And then they can look at the individual fees on those plans and see how it fits into what they're trying to do.
I don't know whether anybody, if it's too basic, because like I said, I think we have a pretty sophisticated audience, whether anybody needs to know how GoalMaker works and why we're advocating GoalMaker at this point.
Well, first off, I want to just say that we don't offer advice. However, through Fisher, which, forgive me, I don't recall exactly how much they charge for that, but for Fisher, there is a advice component. We offer guidance.
Education.
In education. But let's take a step back. There's 15 core investments currently in the plan. So as an investor, you can do your own homework, knock yourself out, choose your investments, 20% here, 20% there, et cetera. That's an option. There are some folks who are more of help me do it. And that's where the Fisher or the GoalMaker may make sense. What is GoalMaker? GoalMaker is an award-winning asset allocation tool that is provided to you at no additional charge. You tell us what your investor profile is. I'm conservative, I'm moderate, I'm aggressive. You tell us the year in which you anticipate retiring. I'm going to retire in 2040, 2035, 2026, et cetera. And then we'll do the rest. The asset allocation tool will provide you with small cap companies, medium-sized companies. You'll have some international exposure. You'll have some bond exposure. It's a great tool. So GoalMaker may make sense. And I encourage folks to take a peek at that. Those models have been performing extremely well. However, we still encourage you at least once a year. As my former mentor, Mark Tomei, would say, on your birthday, come visit with us. You may not remember me. You may not remember much about investing, but you're going to know I need to check in with Darrell, Gene, or Dan to review your investments. We'll let you know whether or not the GoalMaker models still make sense for you and your family. And if you may want to fine tune it, we'll just offer some guidance, give you some ideas, something to think about as you move towards retirement.
And I think the thing to add there too is the biggest thing we focus on when it comes to retirement investing in general is when are we going to start withdrawing money? Because the stock market is always going to have volatility. There's always going to be ups and downs, growth. There's going to be times of loss. But historically, that is always short term. The market has always recovered and continued to grow. So the advisor GoalMaker knows that. And essentially what those do is they put you on what we call a glide path, which basically says in the beginning, when you have more than 10 plus years till retirement, it's going to be more aggressive. And it's going to, because, if there's any volatility, we got time to recover and we're not worried about that because we have more than 10 years still. But the advisor GoalMakers, they automatically update over time. They get safer and safer to get to a more moderate conservative level by the time you hit retirement, because you don't want a lot of volatility happening in your portfolio when you start pulling money out, especially if you're hitting RMD and you're required to pull money out every year. So that's what those advisor GoalMakers do. They don't respond to the market. There's no team that's watching the market. They only update their investments about once a year. But there is a team that's doing the market research to understand what diversified portfolio they should go with in that in that fund. This differs from the professional management though, because as we talked about, Fisher professional management is also available. If you're looking for somebody that is monitoring the market and rebalancing you along the way to try to keep you on track through all of that, that is an option. They base the portfolio off of you as an individual. So they look at like your income sources, your ACERA pension, your Social Security, your time frame, your spending goals, how much you need to pay the bills, and then they build a diversified portfolio based off of that. I believe they charge an annual fee based off of the balance in the account. It starts at 0.36% annually. Easy way to think about that is $3.60 for every $1,000 in your account. And then it goes down from there the higher your balance in the account. I believe all the way up to when your balance is more than 400,000, it goes down to 0.12, I believe. Yes. There's no commitment to it as well. There's no penalties if you decide to change and unenroll. And the county actually has a 90-day like trial period where you can sign up for that service. And if you unenroll within the first 90 days, they don't charge any fee at all. But, it is kind of one of those things where would you rather have a professional driver at the wheel that's kind of trying to keep you on track? Or are you okay with like a passive strategy that doesn't respond to the market? And that's the biggest, where do you see value is where what we tell people.
Right. Right. So that's the only thing that we charge. The only place the fees would ever change is if you joined Fisher.
Yes.
To manage the professional.
It's the only one that has its own extra cost for the service.
There's no other costs from Empower that would cause anybody any fees.
Correct. Just the administrative fees we already talked about and those internal expense ratios on the funds you choose.
Right. Let's talk a little bit about if people have accounts outside of Empower, outside of the county 457 plan. What are some options?
I'll take it. Person has an account, an IRA, et cetera, outside of the county. What are your options now? Is this a retirement account or is this just a taxable account?
The question is not clear. So we've already answered this. So a pre-tax account can be rolled in. Mm-hmm. We'll take the money. Mm-hmm. A post-tax account that you already paid tax on, we can't accept.
Correct.
Right.
Correct.
Right. And then once it's inside of the structure, mm-hmm. All the things we've been saying applies. You can put it into any of the investment options. Mm-hmm. You can put it into the Fisher managed account. You can do a Roth conversion. Mm-hmm. Any things we've it just becomes one big. You can do it yourself. Mm-hmm. One big pool of money.
Correct.
Right. Okay.
Mm-hmm.
Okay. Let me read some questions that I've got. We already talked about the self-directed brokerage account. Mm-hmm. We would consider that. Please let us know if that is something you might like. I was a deferred plan participant when I was at the public defender's office. I've since retired. I have $800,000 in a 401k with Empower. A 401k. I don't know if they mean maybe they move their money. How do I minimize my taxes on that? That's pretty straightforward.
The honest truth is that you want to consult a tax professional. As much as we are amazing retirement plan advisors, we are not tax professionals because you really want to look at your individual tax picture, what your income sources are, what your overall tax liability is, and come up with a strategy with them because it is completely different for everybody and it can be very nuanced and complex. Yeah.
Now here's a question that you asked me not to give you, but we're not economists, so we're not really going to talk about economic issues. But here's a question: there's been a lot of online talk about a financial reset or the U.S. moving away from the dollar. Can we somehow position ourselves to better weather this potential storm? If so, how? So maybe just answer it in terms of, going back to, should you roll your money out? Would you be better off rolling your money out than leaving it in?
I think you could leave a portion of your money in the plan and then maybe move some out, because what I would recommend is that you would go international, get some hard assets like gold and some other, like you said,
It's
private investments.
it's not likely we're going to offer gold in the near future.
How about silver?
Not silver, not crypto.
But the U.S. dollar is still 60% of the assets that's used in international currency. So I think you're fine there. But I do believe that in the plan, you could still invest in some of the international funds. You don't have to do domestic.
Right.
And so you can do that option. But if you want to buy some other things like the gold and silver, you obviously have to move money out. But I think that the dollar is going to probably still be a valuable asset for quite some time. But if you want to diversify, go with the hard assets and then also maybe put more in international.
We are committed to best practices. It's true, we can't offer bespoke solutions to everybody out there who might have a certain need. But we are working on introducing alternative investments, the private types of things into the plan. But we're going to do it in a very safe way. So it'll be probably a mixture. Well, probably not in the time horizon I can see, allowing people to invest all their money into a riskier investment like that.
Well, one thing I would add, and kind of piggybacking off of what you're saying, Darrell, is that international markets over the last couple of years actually have seen more growth than U.S. markets. That is actually very true. And one of the options that is available with the 457 with the county is Fisher does not only offer the professional active management. There is an option on there under the Help Me Do It section called Fisher Online Personalized Advice. And now that is a free service. When I say free, there's no extra cost. There's no annual fee. It is a one-time rebalance into a specific mix that is identified as best suited for that participant. So it factors in the retirement plan that we build on the website, your age, the year that you want to retire, the income sources. It does factor in all of that, and then it creates a diversified mix that follows current market research. So Fisher does factor in what is happening in the market right now. And I can tell you in my own experience, there has been a lot more international exposure through what they show on there. Like they are saying international markets have a lot more opportunity. So for people who are looking for that guidance, that might be an option because Fisher does that market research to tell you based off of what's happening. This is a mix that kind of protects us against that.
Gene, I have a question for you. If anybody wants to entertain using the Fisher managed investment account, you really should input or link your other outside accounts into Empower. That's a definite because that's the information they need, and your spouse's account. They need that information. For people who aren't interested, Gene, in the Fisher, is there still a reason to input your information to link up your other outside accounts into Empower? It's very easy.
No,
I've done it. Yeah.
Absolutely. I encourage folks to, enter the information into the system because when you're visiting with one of us, we'd like to know or have an idea of what your full picture is, your full financial picture, so we can offer you the appropriate investment advice. So absolutely enter that information into the system, but be prepared when we do call you. We may ask you, all right, how much debt do you have? Or how much have you saved for retirement? Or what are your goals? We may ask you those questions before we offer some guidance to you.
Okay. We have 6 minutes left.
Okay.
Let's talk about, let's move to beneficiary information, which, you want to take that? Okay, Darrell, the importance of it and any planning or anything you want to mention about estate planning or anything like that?
Well, I think it's very important that we have all your beneficiaries. If you're married, your spouse is number one. Then you can go to your secondary beneficiaries, which could be your siblings or your children or whomever. But that needs to be on file with the county and Empower so that we can do an orderly distribution of your estate. And so if you are not giving us that information, you are basically putting yourself in the hands of the government to go through a probate system, which could take years before they finally settle the case. And it may not go the way that a lot of people want it to go. So I think it's very important that you have your beneficiaries online with us, on file with us.
Great, great.
One thing I will add real quick too is that with a 457, when you pass and it is given to your beneficiaries, pre-tax dollars, they have 10 years.
Yeah.
They have 10 years to drain the account down to zero. And it will be counted as income in the years that they take the money. So even if you've got hundreds of thousands of dollars divided over 10 years, that's still a large amount of income that can push them into a high tax bracket. So this is another potential reason for like a Roth conversion, because Roth, although they are still subject to the 10-year time frame, it's tax-free. So they don't pay any additional taxes, income tax on that money when they receive it. So that's a big potential benefit.
You're saying if you want to help your
Beneficiaries consider
your
Roth.
kids, you might convert to a Roth.
Yeah.
That's really great advice.
Yeah.
Someone did ask a very complex question, which I won't ask you, about changing your beneficiary and spousal consent. So just make sure to call either one of the advisors or call Empower themselves.
Yeah.
Okay, we're winding up. Anything about hardship withdrawal? Oh, actually, we have one question. Do we provide referrals for tax professionals?
Not specifically through Empower.
We're not really allowed, probably, to do.
No.
Are we allowed to give names, or can we give 3 names, or?
You know, what I've been doing is each one of you have access to EAP, Employee Assistance Program. And from what I understand, you might be able to hire a CPA through the EAP program.
Really?
This is what I've been told. I'm getting information from participants who tell me about it, but it's worth looking into it. You know, I would encourage it.
Okay.
But Hank, if I could just I know we don't have a whole lot of time, but I wanted to touch on beneficiaries because this has come up. As you know, back when when you guys are with Prudential, a lot of the information in terms of beneficiaries wasn't kept online. So you have it in paper form. So I just want to encourage folks, if you don't see beneficiaries online, that doesn't necessarily mean you don't have a beneficiary. It's on file. It's in Hank's office. We have to go find it, but we would prefer just go online and put your new information into the system.
Yeah.
And then I also wanted to touch on that complex question. I did a little bit of research, and I believe it's the one where I want to name my children beneficiary. My husband is out of the country. How do I go about that? And what I did find out is that, yes, we still need your spouse's consent. You can go to the U.S. Embassy in the country where your husband or spouse is located to get the signature authorized and notarized. And then from there, you can change the beneficiary. This is the information that I gathered. I
don't think you'd be able to answer that one. Okay. 2 minutes left, 30 seconds each. Is there anything we haven't covered that in your imagination we should have covered? And what do you want to say about it? 30 seconds.
I'll let you go first. I'm thinking.
I think the biggest one is how to get a hold of us, because this is definitely, as we mentioned at the beginning of this, you get no cost retirement planning with this 457. That's actually our main role, is we meet one-on-one with participants to run through your individual retirement plan. And I tell people, come see us at least once a year, because life evolves, our plans change, our income sources change, and we want to make sure that our investments stay aligned with that, especially as you continue to get older. As I mentioned, that glide path, you want to lower your aggression over time, and that needs to be happening at least once a year. So come see us. Yeah.
I think
last words.
Last words. I would encourage everyone in terms of the retirement planning process. People ask me, Gene, what do I need to be prepared with when I meet with you? Number one, we want to know your salary. Number two, we'd like to know roughly how much you're going to be making prior to retirement, right? So we want that information. Log on to acera.org, create a user ID and password to find out how much you're going to receive from Acera when you retire. Go to ssa.gov to find out roughly how much you're going to get from Social Security. Have that information handy. And then if there is a shortfall, you have your bills, that's a negative. You have your Social Security, you have your Acera. If you're short, then we can dial in how much you should contribute, how you should invest your money to cover that shortfall. So I think that's probably all I'd like to cover.
You get one retirement. Let's make it a good one.
Yeah.
Thanks, guys. Thank you so much. Let's repeat the phone number
Yes.
once more.
855-WOW-457 or
855-969-4572.
there it is.
Call us. You can talk to any of us.
Yeah.
Thanks very much. Have a great day.
Thank you.